Okay, well, I think we've got a critical mass of people into the Zoom room. Well, good morning or good afternoon to you all that are on this webinar. We're very glad that you're here. Welcome to the 2025 Nonprofit Tax Year-End Review. Hopefully, this is a nice break in the action from all of the year-end tasks that you're taking on this December 11th. Not least of which is, are you getting your Christmas shopping done? And hopefully, you've gotten a good start on that and your loved ones are going to be especially glad for the many special gifts that are underneath the tree this year. My name is Chris Purnell, and I'll be your host for this particular webinar, and I'm glad to be with you all for this time. So first off, some housekeeping things. For those of you who are interested in some continuing professional education units, listen up. Number one, CPE is being offered for this webinar, 1 credit hour. CPE hours are calculated at 50 minutes as an hour. There is no partial CPE credit being offered. Please, hopefully you've logged in with your unique link that we sent to your registration and stay logged in for the entire webinar to make sure you receive that very important CPE credit. You must answer at least 3 poll questions throughout this hour of CPE. Now, here's a scoop. Some of these poll questions are actually kind of difficult. So that should tell you 2 things. Number one, you should listen up, pay attention, do your best. And number two, just know that there's not any shame if you get 1 or more of these poll questions wrong. However, if you get 2 wrong, then you don't get CPE credit. I'm just kidding. We're not keeping track of whether you get it correct or not. That's one of the beautiful things here. If you get them wrong, that's okay. You can still get CPE credit. We just need you to answer at least 3 poll questions. Certificates will be distributed via email within 7 days of this event. If you have any questions about the certification process, you can send those to marketing@criadb.com, and there will be a CPE survey in the web browser immediately following the webinar. And for those of you who want to relive the magic by taking a look at the PDF of this presentation at some point in time in the next few weeks when you're gathered around the fire with your family and friends, you can get a PDF by going to capeandkrause.com or criadb.com. So what are we talking about today? Well, the year has brought fairly significant changes in the world of tax, and more particularly for our topic, tax for churches, higher education institutions, and other exempt organizations. So you need to be aware and plan. Some of these are already in effect. Some are going into effect soon. So we're glad that you're joining us, Carr, Riggs, and Ingram, and Cape and Krause, which is a division of Carr, Riggs, Ingram, for a look at the key provisions in the One Big Beautiful Bill Act, or as it will be called during this presentation, the OB3, and other recent developments, along with what I like to think of is pretty spectacular insight from our presenters. And we're going to give you some practical takeaways to help you stay compliant and always prepared. So what are the learning objectives? Well, there are 3. If you learn more than 3 things, man, wouldn't that be awesome? So number one, you're going to identify tax changes during 2025 that directly affect tax-exempt entities, including provisions in the OB3. Number 2, evaluate and plan for how these changes may impact your operations. And number 3, implement regular annual tax reporting and prepare for future year reporting changes. So that is our goal, that you walk away with those 3 things learned and in your mind and in your heart. So who will be presenting today? Well, I'm glad you asked. First off, there's this guy who's on your screen right now, Chris Purnell. I am an attorney licensed to practice law in the great state, the football state of Indiana, and I am a partner with CRI Advisors, and I am based out of our Indianapolis, Indiana office. Next up is my fellow partner in the tax compliance side of things. This is Darren Dyga. She's a CPA. She is also a partner based out of our Indianapolis, Indiana office. And last but certainly not least, we have Ashley Peabody, who is another fellow partner on the tax compliance side of things, and she is also out of our Indianapolis, Indiana office. So if you want to go ahead and clap where you are, you can, or snap, or whatever you feel like is is appropriate and germane to thanking the presenters as they are on your screen. So what's our agenda? Well, more particularly, we've got 8 things that we're going to walk through this morning or afternoon. Number 1, the impact on charitable contribution deductions from the OB3. Number 2 individual income, gift, and estate tax changes, changes to education benefits, payroll and payroll reporting changes, Form 990 and 990T updates, year-end tax matters, clean energy credit changes, and the employee retention credit updates. So, without further ado, I'm going to turn the presentation over to my good friend and yours, Ashley. So, Ashley, take it away.
Thanks, Chris. Appreciate that generous introduction. It's great to be here today with you all. Thanks for joining us and spending some time of your afternoon learning about these tax updates. Our first topic is discussing how OB3 will impact charitable contribution deductions for both donors who itemize and those who use the standard deduction. Beginning with the 2026 tax year, non-itemizers can deduct up to $1,000 for single filers and $2,000 for couples married filing joint. To be eligible, the cash contribution must be made to a public charity. This means that gifts to donor advised funds or gifts to private non-operating foundations are not eligible. Because this is an above-the-line deduction, it can be taken in addition to the standard deduction. It's also important to note that this provision is permanent and not indexed for future inflation. Go to the next slide, Chris. All right, next is the 60% AGI limit for cash contributions to public charities that was introduced by the Tax Cuts and Jobs Act, or referred to as TCJA, has been made permanent under OB3. Because this 60% cap is higher than the previous 50% cap, it may encourage larger charitable contributions within a single year. Keep in mind that donations to private foundations remain capped at 30% of your AGI. We can go to the next slide, which I believe is our first polling question of the session. So we'll get that launched here for you. You should see it up on your screen. Again, a reminder, don't have to get it correct, but please answer for CPE purposes. So for this question, all of the following statements are true except one. So we are looking for the statement that's not true. We have A, married taxpayers filing a joint return who do not itemize deductions on their return can claim a non-itemizer charitable income tax deduction of up to $3,500 for charitable gifts to public charities other than donor advised funds. B, the charitable contribution deduction for non-itemizers goes into effect on January 1st, 2026. C, the TCJA first introduced a 60% AGI limit on cash contributions to public charities beginning on January 1, 2018. And D, OB3 made the 60% AGI limit for cash contributions permanent, effective January 1, 2026. So again, we are looking for the statement that is not true.
And Ashley, we're around 80%, so we're going to give them just a few more seconds.
Excellent. Keep those answers coming in.
Okay, I'll keep it open for another 10 seconds. We're at 88%. Okay, I'm going to end the poll, and it looks like most people answered A, the married taxpayers filing a joint return who do not itemize deductions, etc. Ashley, what is the correct answer?
Well, good job to the majority of folks, because A is the correct answer. That was not the true statement. Married taxpayers filing a joint return who do not itemize can only claim a deduction up to $2,000 as opposed to the $3,500 that was in the question. So good job to most of the folks here getting off to a strong start, getting that one correct.
Fantastic.
Okay, so we will move on to our next topic here. We'll look at the new 0.5% floor applicable to individuals' charitable contributions. For donors who itemize starting in 2026, only the portion of your charitable giving above 0.5% of your adjusted gross income will be deductible. An example of how this works out mathematically is a married filing joint couple with AGI of $200,000 could only deduct charitable contributions in excess of $1,000. Please note that any non-deductible amounts can be carried forward up to 5 years. Also, starting in 2026, charitable contributions made by corporations will only be deductible if the company gives at least 1% of its taxable income. And again, any unused deductions may be carried forward up to 5 years. So just a couple of things to be planning for as you look at your contributions going forward. Starting in 2027, there is a dollar-for-dollar federal tax credit up to $1,700 for contributions to scholarship granting organizations. These are organizations who are required to use the contributions to grant scholarships to students at private and public elementary and secondary schools located within their state. To qualify for the credit, a contribution must be made to a state-recognized scholarship granting organization, which need not be located in the same state as the taxpayer. Please note that this credit is reduced by any credit allowed on your state income tax return, and contributions for which a credit is claimed cannot be reported as a charitable deduction. The piece limitation, which was scheduled to return January 1st, 2026, was actually permanently repealed. So effective for tax year 2026, there is a new permanent limitation, which applies to taxpayers in the highest income tax bracket. This new replacement limit is that itemized deductions are now reduced by 2/37, very specific correction here. So 2/37 of the lesser of the amount of itemized deductions before taking this into account, or the amount of taxable income exceeding the start of the 37% tax bracket. For 2025, those thresholds are $626,350 for single filers, or $751,600 for married filing joint. So again, something to look at if that happens to be an applicable tax bracket for you. Now I will turn it over to Darren to give us our next set of updates on individual income, gift, and estate tax changes. Darren, take it away.
All right. Thank you, Ashley. You may be wondering why we're covering individual income tax topics in the nonprofit year-end webinar, but some of these have a lot to do with charitable giving, and so therefore we thought it would be beneficial for you to hear about them, and hopefully everybody is filing their own individual tax return who is on this webinar today, so it obviously is relevant to you personally as well. So just want to spend a little bit of time talking about some of these items. The first two are related to itemized deductions. Again, that would have an effect on charitable giving, since charitable contributions can be an itemized deduction subject to certain thresholds, and these would also factor into that. So the first is mortgage interest itemized deduction. This deduction was made permanent by the OB3, where you can deduct up to interest paid on up to $750,000 of qualifying mortgage debt for your primary or secondary home. This also includes home equity lines of credit if the funds are used to buy, build, or substantially improve your qualified residence. This is in place for 2025 and is also effective for made permanent for 2026. Additionally, in 2026, there's also certain mortgage insurance premiums that can qualify as deductible mortgage interest. On the next slide, another change with the OB3 is an increased deduction for state and local taxes, such as your state income tax and your property taxes. Under the TCJA, the Tax Cut and Jobs Act, this was capped at $10,000. So you can see the deduction has increased substantially, $40,000 for single married filing jointly and head of household, and $20,000 for married filing separately. There is a phase out here, as you can see, but that will never decrease the deduction below 10,000. And then for 2026, some adjusted amounts increasing 1% annually from 2026 through 2029. And then in 2030, it will return to that $10,000 cap. So not a permanent increase, but an increase for 2025 through 2029. All right, on the next slide, not an itemized deduction, but rather a dependent care assistance FSA limit, important for you as a nonprofit employer to have visibility to this. So the increased limits for 2026 is up to $3,750 for individuals and $7,500 from couples. So before that was $2,500 in 2025. That was $2,500 for individuals and $5,000 for couples. So a substantial increase on this as well. Impact again on you as a nonprofit employer. Just make sure you're taking this into account and perhaps adjust those benefit packages accordingly. Child tax credit enhancement. The OB3 increased the credit for each dependent child to $2,200 versus $2,000 in 2024. This will be effective for 2025. This is a refundable credit. So this is not a deduction, but this is rather a credit that's taken once you calculate your tax due. And it is refundable if you happen to have more in credits than you do in tax due. And that would be up to $1,700 per dependent. Changes in standard deduction. So if you're not itemizing your deductions, you're just taking the standard deduction, there is a little bit of an increase in that amount from 2024. So for 2025, it's $15,750 for singles, which was $14,600 in 2024. $23,625 per head of household, up from $21,900, and $31,500 for married filing jointly, which is up from $29,200. This is going to be indexed for inflation, so you can see the amounts increased there for 2026. And again, this is a permanent increase with the effective date starting in 2025. OB3 also brought to us an increase in the lifetime estate and gift tax exemption. So this isn't the yearly one we're talking about, which is $19,000 for 2026. This is the lifetime exemption. So this exemption has increased. It's now up to $15 million per individual, which means that if you're married, if you're a couple and married, it would be up to $30 million between the two of you. This was $13.61 million for 2024 and $13.99 for 2025. So a substantial increase there. That's going to be effective January 1st, 2026. The next couple slides have some key tax figures. I'm not going to go through each one of these here. And this is specifically for the tax year 2026, but wanted to include these in the slides just so you had them for your information. And next, gonna throw it over to Chris to talk about changes in education benefits.
All right, thanks, Darren. So the OB3, it did a lot of things. What's interesting is that it could have done so much more. The House version of this thing was an exceedingly robust, and the one that eventually got passed and signed into law back on July 4th, 2025, was a little bit more subdued in some ways. So, but it did change a lot of things. One of the things that it changed was with regard to education benefits. So we're going to walk through some of those things that took place. Number one, the use of a 529 plan. So if you have children, grandchildren, nieces or nephews, or advise people who do, you may have invested a little bit of money into a 529 plan. These are plans that are sponsored by the various states in our great republic, and they have very discrete uses. There was an expansion of the use of 529 account funds back in 2017, thanks to the Tax Cuts and Jobs Act. And those are still ongoing and still here. But now they've been expanded upon thanks to OB3. One of the expansions relates to primary and secondary education. You can include lots of different types of fees beyond just tuition, including curriculum and books and online educational materials, tuition for tutoring or educational classes that are outside the home, exam fees, and educational therapy. Keep in mind, though, that there is some nuance, especially in the educational therapy space, where you'll just want to make sure that your particular educational therapist meets the requirements that are set out in the actual law, because it does have some kind of requirements that the person be licensed and have some credentialing and that sort of thing. So it can't just be like Uncle Bob coming over and teaching your kid how to read, unless Uncle Bob is credentialed, then that's okay. But there's some nuance there. And the effective date for that expansion was Independence Day of 2025. Another expansion relates to post-secondary education, but education that's a little bit off the beaten path. So credentialing, program costs, tuition, books, supplies, testing fees, professional continuing education fees. So these are for folks who are maybe going to a trade school, getting a credential as opposed to going to a traditional university. So as you can see, what OB3 is trying to do is trying to expand the ambit of applicability for what these 529 plan amounts can be used for. And so that's a big one right there, post-secondary education. And that was effective July 4th of 2025. And the last expansion of the 529 account that I'll mention here is back in the Tax Cuts and Jobs Act, the TCJA, it allowed for up to $10,000 in annual expenditure for primary and secondary school. That has now been expanded to $20,000. And that goes into effect as of January 1st of 2026. So what's the theme here? Well, the theme is that there's an expansion of the use of 529 account funds. What's that tell you? Well, they're trying to increase the incentives to invest in 529 plans more generally. Educational assistance programs. This is under Internal Revenue Code Section 127. Many employers use this as a retention tool or recruiting tool. And basically what it does, it says that if you as an employee do any kind of education that fits underneath the ambit of the educational assistance program rules, then your employer can pay for up to $5,250 worth of the education, and it is not taxable to you. It doesn't have to have anything to do with the employer's business. It doesn't have to fit you for a credential or make you a better employee. It could be underwater basket weaving. It could be romantic literature, which would be my favorite if I were to do this. So this was $5,250 per employee. Well, what OB3 did was it did a couple things. Number one, it made that 5,250, which has been the number since time immemorial. It's kind of baked into the pie. It actually indexed that for inflation, so that 5,250 will actually go up year over year. But number two, and maybe more importantly, if any of your employees have student loans, which you got to think that there's some kids out there, and excuse me, young adults out there who have some student loan debt. Well, what the CARES Act, way back in 2020, the date which we shan't speak of ever again, the CARES Act, what it did is it said, hey, employer, if you want to pay for student loan repayment, you can use some of that 5,250 or all of it towards student loan payments, whether paying down the principal or interest or the payments more generally. And what the OB3 did is it said, we want to make that permanent. So that student loan repayment change is now permanent. It never went away. So yes, it goes into effect, quote unquote, January 1st, but since it's had ongoing applicability since 2020, it just means that it continues on. So that's all good news. And now, speaking of good news, we're on to our next polling question. Polling question numero dos. So again, these are tough questions, all right? And this is probably the worst way to phrase a question. It's meant to be a gotcha question. But hear my heart when I say that I don't like doing this, all right? But here are the options. All the following statements are not true, except, so you're looking for the statement that is true. A, 529 plan funds can be used to pay up to $20,000 in primary school tuition in the fall of 2025. B, 529 plan funds can now be used to pay continuing professional education fees. C, the 1,700 credit for contributions to state scholarship granting organizations is allowed irrespective of whether a credit is claimed on a state income tax return. And D, employees receiving qualified overtime pay may now deduct up to $50,000 in qualified overtime pay from taxable income. Now you may be thinking to yourself, hey, Chris, I heard something about this overtime pay deduction, but it's lost in the mist of time. Maybe a synapse fired at one point in time, but I do not remember it. Well, that's because we're actually going to cover this in a later slide. So if you know the answer to this one, then bully for you. Good job. But if you don't, that's okay. No shame here. And we're hovering right around 75%. We're doing good work here. Okay, so we do have a question that I'll go ahead and answer while folks are answering the polling question. Is a 529 for primary, I'm assuming that's primary school expenses, only if your state opts in? So this is an interesting question. The answer is you do need to take a look at what your state is saying. Is your state allowing for primary school expenses? Have they made that change? Have they made that adjustment? Or are they holding on to maybe the old school where it was just for higher education? So take a look at what your state requirements are. That's an important thing to keep in mind. Thanks to the question asker. All right, we're hovering around 85%. We've been waiting for 2 minutes and 25 seconds. So I'm going to go ahead and end the poll here. And the results are, oh, it's spread pretty evenly, which means that I have not done my job. Many apologies. The answer is B. The answer is B. 529 plan funds can now be used to pay continuing professional education fees. This is part of the expansion of use of 529 funds that was put into place underneath OB3. A is not true because that doesn't go into effect until 2026, that $20,000 increase. C is also not true because the $1,700 credit is only allowed, and it is respective of whether a credit is claimed on a state income tax return. And D is not correct because, well, you'll see in just a few slides, thanks to my good friend Darren, who is now going to pick up on the next topic.
Yeah, they don't have to wait long, Chris. So I'll be talking about some payroll and payroll reporting changes. And the very first slide talks about overtime pay and tip deductions. So I feel like we've heard a lot about this in the news. No tax on tips, no tax on tips. That's just what I keep hearing every time I read this slide. But first, let's talk about the overtime pay deduction. That is a new deduction from the OB3. And that is limited, though, to $25,000. So whereas the poll question had it at $50,000, the deduction is limited to $25,000. So if you make over that and in overtime pay, that is taxable. The tip deduction, again, is also limited to $25,000 in cash tips. And this cannot be anything that is an automatic gratuity or a mandatory service charge. So I think, we've all been to those restaurants that have that service charge added to the list when it's a certain party size. I don't think it can be that. So I think that would fit the mandatory service charge. So it would be that cash tips above and beyond that. There is a joint return requirement. So for anybody who is a married individual, the deduction must be claimed on a married filing joint return, not a married filing separate. And there is some phase out criteria that applies there. $300,000 for married filing joint, $150,000 for single. If AGI is above those, then you have to reduce it by $100 for each 1,000. And the effective date of this is January 1st of 2025. So the OB3 does require that employers include this information regarding overtime pay and tips on the Form W-2. However, it's important to note that there is transition relief for 2025. So employers do not have to do this on the 2025 W-2s, although it is encouraged, but there will be a requirement for 2026. So just wanted to make sure that that was that piece of information came out later, not required for 2025, but encouraged. The Treasury has also published proposed regulations that includes a list of occupations where workers customarily receive tips. And so we've included those types of occupations here on this snapshot to help you determine whether or not this would be a requirement for you. Moving on a little bit, somewhat relevant to what we just talked about, but more for 2026, some wage and contractor reporting requirements. So as we mentioned, the W-2 form for 2026 must include the overtime and tips information, not for 2025, but 2026. And then we'll also see a change to Form 1099 reporting in 2026. So right now, the threshold for having to provide a service contractor a 1099 is $600 for 2025 and for years prior. In 2026, that threshold will rise to $2,000. So that will alleviate any payments made to service contractors below $2,000 from needing to be included on a Form 1099, typically filed by the end of January of each year. These will be indexed for inflation, as you can see at the very bottom there, beginning in 2027. And I believe that takes us now to our third polling question. All right, so here we are. All of the following statements are true. So not like Chris's question where they are not true. All of them are true except, so we should have one false statement here. The standard deduction for married couples filing a joint return is $32,200. B, beginning in 2026, a non-itemizing single taxpayer can claim a $1,000 charitable contribution deduction. C, OB3 creates a new 1% floor applicable to individual charitable contributions. Or D, the AGI limit for cash charitable contributions to public charities has now been permanently increased to 60% of AGI. I will tell you, it's not super obvious. Might be just a slight change in number here to determine which one is false. Looks like we're about 66, 67%. So we're going to give it a few more minutes here. Chris, any questions in the chat that you can answer while we're waiting for everybody to participate?
So one did come in, and the question is, has the IRS provided guidance to employees for determining tip income if the employer does not have to report it to them? And as far as I've seen, I have not seen the IRS provide direct guidance on that question. Now, could some come in between now and the hurly-burly of tax season in the first quarter of 2026? Well, sure. But basically what this requires is that the employee is going to have to figure it out on their own, which is not a really comforting thought. But that's where we are when there's a mandate from Congress and there's not really great ways to get it out there.
And it looks like we're at about 85%. Give it a few more seconds here. All right, I'm not seeing much progress, so I think we can probably go ahead and move on. So the correct answer here, which means the answer that is false, is C. That 1% floor does not apply to individuals, that applies to corporations. So the percentage that applies to individuals is a 0.5% floor. All right, Form 990 and 990T update. This is a very short section, so not a lot of updates happening in the 990, 990T world. Thank goodness. I think I hear a lot of you saying, for those of you who have to file the 990 and 990T. On the next slide, we did highlight here that the penalty for late filing of the 990 has been inflation adjusted. So for organizations with gross receipts in excess of $1,339,500, that penalty is $130 a day, up to a maximum of $66,500. So a little bit of an increase in those penalties. On the next slide, OB3 did bring about some changes for those organizations that have to file the 990T for unrelated business income tax, and the first being in the area of depreciation. So OB3 did make permanent the $1,000 bonus depreciation deduction. So that is good news. For 2024, that bonus depreciation deduction was at 60%. It was supposed to be 40% in 2025. You can see that 40% still applies for property acquired in that January 1st window to January 19th window. But otherwise, if property was acquired after that in 2025, you can take 100% bonus depreciation. Likewise, we saw an increase in the expensing amount for Section 179, which is also some advanced depreciation. That amount is now to 2.5 million, where it was 1,220,000 for 2024. This will be phased out for total acquisitions over 4 million. Also effective again in 2025. OB3 also made permanent the Section 199 Cap A deduction. This is a qualified business income deduction for those tax exempt trusts that have ownership in qualifying partnerships, S corporations, etc. So again, this only applies to our tax exempt trusts that are filing 990Ts. This does not apply to corporations filing the 990Ts, but this deduction is a 20% deduction of the income from those types of activities, subject to certain thresholds and phase outs, which we didn't include on here, but just wanted to mention that that was made permanent by the OB3. And those are the two items that were changes as it relates to the 990 and 990T that we wanted to highlight. So now I'm going to turn it over to Ashley to talk about other year-end tax matters.
Thanks, Darren. In this section, we are going to go over some items for you to consider as the calendar year comes to an end. You're looking ahead to what 2026 might look like and make sure that you get 2025 successfully closed out. So our first reminder is the all familiar payroll reporting forms of W-2s and 1099s that your organization will be getting ready to prepare. So first, for your Form W-2s, it's important to confirm you have updated address information in your payroll system for your current employees. And as an employee, if you have moved or updated your information during the year, make sure you have reached out to your employer to ensure they have that correct information when they are preparing your W-2. It's also important to confirm you have current addresses on file for any former employees who might have separated from service during the year, but will still receive a W-2 for you for the 2025 tax reporting year. For the Forms 1099 NEC and Form 1099 Miscellaneous, it's important to make sure you have a completed Form W-9 for all contractors or all Form 1099 recipients on file. You should also be periodically reviewing the rules for when a 1099 NEC and a 1099 miscellaneous are required now that there are two forms. So check those instructions to confirm you have completed the correct one. I will tell you that when completing these forms, LLCs really are the tricky ones, and it's important to make sure you have a W-9 that is completed in a manner that assists you in determining what you should do for that LLC and ensure that they are receiving the correct payroll form for your organization. The other overarching reminder is that when you have W-2s and 1099s, to make sure that you have correctly classified persons between employees and independent contractors. IRS Publication 1779 is handy in referring to what those federal employment tax standards may be to ensure you are issuing W-2s as appropriate to employees and 1099s as appropriate to your independent contractors, and not issuing an incorrect form to someone based on what their classification should be. On our next slide, we have some due dates here for your reference as you file W-2s and 1099s, what those due dates could be to make sure they are in hand with the individuals for their applicable tax filings and to make sure they're in compliance with IRS filings. So those government copies are filed by those appropriate due dates. Please note the distinction on your screen here between due dates that are for paper filing and for e-filing. There are specific e-file mandates that apply to organizations that file more than 10 forms. And those 10 forms can include Form 990, Form 990T, Forms W-2, and Form 1099. Again, if you have more than 10 forms, you're required to electronically file. So make sure your organization is paying attention to those thresholds and e-filing as appropriate. Next, we will cover tax-deductible contribution reporting. First item is the timing of issuing receipts. So when does that need to happen? So receipts must be issued by the donor by the earlier of the date on which the donor actually files their federal income tax return or the due date, including extensions of that return. So if your organization issues annual donor statements at the end of the year summarizing all gifts rather than issuing receipts throughout the year as gifts are made, we recommend as a matter of good donor relations to have those annual donor statements issued by January 31st. That helps ensure that the donors have this information before they are going to file their personal tax return. On the next slide, this has a reminder that to claim a deduction for a single gift that is $250 or more, a donor must obtain a contemporaneous written acknowledgement, fancy word for a receipt, of the gift from the charity. The requirements of the contemporaneous written acknowledgement are described in IRS Publication 1771. We have that linked for you. Recommend you bookmarking that, taking a look at it. It has a lot of helpful information for you as you are issuing these receipts. Please note that receipts should specifically include a statement regarding goods and services provided in exchange for a gift, or a statement that no goods or services were provided. This is referred to as a quid pro quo statement. On our next slide, we have some sample quid pro quo statements for your reference that you can choose the one that applies to your situation and use it on your receipts as applicable. So our first example is one that churches commonly use. It states that no goods or services were provided in exchange for your gift other than intangible religious services. Other organizations commonly use the phrase no goods or services were provided in exchange for your gift. Now, if goods or services were provided, we also have an example for you here where you can use the phrasing you received goods or services with an estimated fair market value of X dollars in exchange for your gift. So again, some helpful references here that you can customize as needed on your various receipts. Okay, next we will cover the housing allowance. As a reminder, a housing allowance must be designated in advance of payment by an official action of the governing body. This is often done by a board resolution. And a reminder, the best practice is to complete these designations by December 31st, which is very, very quickly approaching. However, this must be done no later than the first payroll that is run in 2026. So depending on what your payroll schedule is, pay attention to that date if this doesn't happen to get done by December 31st of this year. On this slide, we've included some general reminders regarding the housing allowance. Due to time constraints, we won't cover this topic in detail, but again, wanted to provide some reminders to you here that first of all, ministers are not subject to FICA taxation, so make sure everything's set up appropriately for that in your payroll system. Secondly, that voluntary withholding arrangements should be updated using Form W-4 and also ensure that the individual's name, address, social security number, all of those details are correct on that form. And lastly, please make sure if you have hired any new ministers or if you have any newly ordained, licensed, or commissioned any minister to please check with your payroll provider to ensure that they are correctly classified and that the withholdings are accurate. I will tell you that this third bullet point on the screen is the common error that we see in organizations. So it's helpful to review this internally and make sure everything is set up appropriately in your payroll system so that when payroll documentation documents are issued, everything is appropriate and in compliance. And I believe this brings us to our last, but certainly not least, polling question of the day. Again, we have the tricky wording where it says all of the following statements are not true except. So we are looking for the one true statement among the four. I will read these. And again, we're looking for the true statement. So A, the $5,250 limit on Section 127 educational assistance program payments will be indexed beginning in 2028. B, the new deduction for overtime pay allows a $20,000 deduction for married couples filing a joint return. C, the maximum amount that can be contributed to a dependent care flexible spending account is now $7,500 for married filing joint or $3,750 for single filers. Or D, the reporting threshold for Form 1099 miscellaneous and Form 1099 NEC has been doubled to $1,200. So again, we are looking for the true statement among these four items here in front of you.
Awesome. Awesome. And actually, as the results come in, I figured this would be an opportune time for me to answer some of the questions that have been coming in the Q&A box. Some of these relate to the overtime pay and how employers should break those amounts out. How do they note those on the W-2? What happens if a person works in 2025 but doesn't get paid until 2026, et cetera? And what I would say to all those questions is, we don't have clear guidance from the IRS just yet. We don't have a Form W-2 that is going to be readily able to break those amounts out, which is why the IRS essentially threw up its hands and said, we strongly encourage you to figure out how to do it, but we understand that it may be difficult for you to do it. So I would say that to the extent that you can do your best, please do your best. One question that I think I can answer is, should the employer report to their employees the full overtime an employee has earned or only the overtime premium amount? And I think that's one where you may want to do both, where you put down, here's the full amount of overtime wages over the course of time, over the course of the calendar year, and then here's what the overtime premium amount, i.e. that half in the time and a half amount that you earn for overtime, that would be the overtime premium. To the extent that you can do that, that'd be great. To the extent you can have both those numbers, that would be wonderful. But again, we don't have a real live W-2 from the IRS that's been retrofitted to make that happen. So do your best. And we are sitting at 86%, which is pretty on par with the rest of our polling questions. So I'll go ahead and end the poll. And Ashley, it looks like 45% answered C. What do you think?
All right, feeling good. Two for two out of my questions here. Again, C is the correct answer. So good job to most of the folks getting that one correct. Again, these are very, very tricky questions. I can run through why the others were not correct for anyone who is particularly interested. So for the first one, for item A, this is not correct because the educational assistance changes apply starting in 2027 rather than 2028 as stated. B is incorrect because the overtime deduction is now $12,500 per worker, making that $25,000 for married filing joint rather than the $20,000 you see. And then for item D, the new 1099 miscellaneous and 1099 NEC threshold goes up to $2,000 for 2026, as opposed to the $1,200 in front of you. So good job to most of the folks on the call. And Chris, now I believe it's up to you to tell us the latest about clean energy credit changes.
My goodness. Yeah, the thing that people have been waiting for. So thank you so much, Ashley, and thank you so much, Darren. I'm going to answer a couple more questions before I jump into my final two sections. One person asked, if a new qualified housing allowance employee starts after the first of the year, do they have to wait to process the housing allowance till the following tax year? And the answer is no. No, you do not have to wait. And if the housing allowance is a significant benefit to that particular employee, I'm sure they would rather you not wait. The only rule when it comes to the timing of the housing allowance designation is that it must be designated in advance of payment. Now, the reason why we say it's smart and maybe a wise and prudent practice to do it at the end of the year prior to the first of the year. It's just because it's a nice way to remind yourself, okay, here's the checklist. Here's what I need to get done before the first of the year. So that way, the person can just continue moving along with the housing allowance amount that they're getting. However, if you miss it, that's going to be okay. Just pick it up whenever you find out about it and make sure that you designate an amount for the go forward. So for instance, if you miss it and then you discover it in February of the following year, then the housing allowance designation amount can only be for expenses incurred after February of that year. So February to the end of the year. So all is not lost. Just go ahead and designate an amount and move forward. The next question that I'll respond to as best as I can you confirm that the OT, the overtime that is eligible for the deduction, is based on the federal rules rather than the state? And they mentioned the great state of California calculation rules. And the answer is, I am pretty sure it's based on the federal rules. I am 95% sure. But it may warrant just a little further investigation. But I would suggest that I'm fairly certain that it's the federal rules. Okay, let's talk about clean energy credit changes, because there were several. So the Inflation Reduction Act, it provided a pathway to claiming clean energy credits for tax-exempt organizations prior to the Inflation Reduction Act. It wasn't really possible because, just as the name suggests, these were tax credits. But if you are a tax-exempt entity, meaning you do not pay tax, a little asterisk there for those who are 990T filers, but you don't pay tax, then you don't really have an opportunity to take a tax credit. Well, the Inflation Reduction Act changed that and provided a bunch of new sections to take a look at. But as they say, Lord giveth and Lord taketh away. So here's the taketh away. Basically, a lot of the timelines for claiming these credits, whether it's for residential or commercial, or in the case of many of our tax-exempt organization clients, the Clean Electricity Investment Credit, which I'll get to on the next slide, the timelines have been pretty drastically shortened. So I'm going to go ahead and just, I'm not going to bury the lead. Usually our clients are claiming the Clean Electricity Investment Credit, and even more particularly, they're claiming it for wind and solar. And maybe even more specifically, the funnel gets really, really small. Most of our clients, 9 times out of 10, it's solar power. So what OB3 did is it said, if you want to claim the Clean Electricity Investment Credit for a wind or a solar project, then if the construction on that project begins after July 4th of 2026, so that's in roughly 6 to 7 months, the project must be placed in service by December 31st of 2027. So what does that mean? Well, that means that they're trying to incentivize you to get started on this sooner. Because if you do it before July 4th of 2026, meaning you start construction before July 4th of 2026, then you have a much longer time horizon to claim that credit. It goes out to 2030. So an extra 3 years, essentially. But there's another kind of wrinkle to this that I want to mention. If there are stronger foreign entities of concern, or FEOC rules, that went into effect via OB3, and those go into effect for projects where construction begins after December 31st of 2025. So if you have a project that begins construction after December 31st, 2025, but prior to July 4th of 2026, then when it comes to claiming the credit, you've got plenty of time. However, your project would still be subject to the pretty intense FEOC regulations that are out there. So keep that in mind. There may be some wisdom to trying to get into some kind of safe harbor where you perform significant work or substantial work, or maybe there's a 5% payment safe harbor that you could take advantage of to get that done even in 2025. I've got a few clients that are trying to do that, so that way they're not subject to those intense FEOC rules. So keep that in mind. All right, that's all my updates by way of the clean energy credits. we have several different resources out there, including a couple of just really dynamite articles about the clean energy credits and all kinds of other things from OB3 on our website, criadv.com or capeandkrause.com. Now I want to end with the thing that I lived, slept, ate, and breathed for several years, the employee retention credit, or as sometimes it's referred to, the employee retention tax credit. I know that sometimes the T is not there, but I had one practitioner friend of mine who said that anytime he saw the T, he said that that stands for trouble. We've got trouble right here in River City from my theater friends out there. So what's going on with the employer retention credit? Why won't this thing just go away? It's been around for over 5 years, going on 6. Well, so the employer retention credit, I don't know if you knew this, but it was subject to all kinds of fraud and abuse. So the IRS was turning a heat lamp on it for quite some time. There were criminal prosecutions, all kinds of stuff that was going on. Well, by way of trying to continue to increase enforcement against some of these bad actors, the OB3 added a $1,000 penalty for each failure to comply with due diligence requirements by, quote, COVID ERTC promoters. So these are folks that were going around and saying, you are entitled to millions of dollars and we'll only take a small sliver, 30% of that amount in order to help you file this 941X paperwork and yada, yada, yada. So $1,000 penalty, it doesn't seem like a lot and really it isn't, but at least it's something, and that went into effect on July 4th, 2025. And another enforcement measure, the IRS now has up to 6 years to audit the employee retention credit claims for Q3 and Q4 of 2021. So let's say that you claimed Q3 and Q4, or maybe just Q3 of 2021, and you waited to the last possible moment to do that, which would have been January 31st of 2024. That means that the IRS has 6 years from January 31st of 2024 in order to audit your claim of the credit. And yes, friends, that is 2030, the year of our Lord, 2030, for the IRS to assess your employer retention credit, which was based upon things that happened in 2021. This is the world we're living in. So that also went into effect on July 4th of 2025. We are very honored that you took an hour of your time to spend with us talking about all these year-end tax matters and things that have taken place in 2025. You can learn more and follow your scintillating friends at Cape and Krause on social media. Connect to Cape and Krause, Facebook, Twitter, Instagram, etc. We do not have a TikTok account just yet, but we're working on it. So feel free to check in with us on your favorite social media channels. These are the presenters who have been able to provide their guidance today. Many thanks to Darren Dyga and Ashley Peabody. You guys did a wonderful job. Thanks for lending your expertise today. And again, we're grateful to you for spending a little bit of your December 11th with us. We hope that you have a very Merry Christmas. And as always, if you have any questions about tax matters or things that are around tax compliance, 990 nonprofit issues, etc., please feel free to reach out to us and we'd be happy to assist. So take care and reach out anytime.